You wake up the next day and someone tells you, surprise, here's your new employer. That doesn't feel good. The ESOP should support a great culture and reinforce it, but not be the defining characteristic of it. What does success look like in this thing? And it's a couple hundred millionaires that this business provided for.
Welcome to the Nuance Effect.
Thanks for having me.
Today we have Charlie Christensen, newly minted CEO of the Christensen Group.
Thank you.
And I know I did a great job prepping you.
Yep.
So you're like, why am I here?
Yep. So are we going to go through the list of everything? Yeah.
Oh, I mean, like, think of the list as like a teaser.
Okay.
We'll go through kind of like who you are, like how you moved into the ESOP.
Sure.
Because I think that's really interesting. And then I'll just talk to you a little about like some of the compensation and like strategic elements within it.
Yep.
But to answer your question before, I'm writing a book. And basically I had this theory that I've seen kind of play out in a number of businesses, including like mine. And basically, I think like customer segmentation sometimes needs to be employed inside of an organization. So when you think about like the departments that move your business, sometimes you'll find one that will completely decimate performance if they all walk out of the door tomorrow.
Yep.
And if you have a group like that, you should have a strategy around engaging them.
Yeah. Well, it's the old 80-20 rule.
Absolutely.
And it works for clients and your key performers.
A lot of times I think it gets forgotten, especially when you get like a leadership transition or any kind of M&A activity.
Yeah.
Where it's like you do all this due diligence and then you forget like most of the time those key people are there for a reason that's like softer.
Sure.
Where it's like, oh, why are you here? I make good money. And then it's like, my boss always recognizes my performance, or I have a ton of flexibility, or pick a thing. Our mission's on point.
You know, the hardest part though is I imagine, at least with customers, you can drill down and find, contribution margin by customer, customer segment, and you can drill into the, where your bread's really buttered. But with people, your internal people, sometimes it's hard to really dive in and figure out exactly who's the highest performer. It's not always obvious.
Yeah, and that's where I'm thinking, like with my content, it's less about finding the highest performing people. It's about finding the highest performing groups within a function. So for like care, our therapists were our thing. They like retaining, so in behavioral health, on average, when we started, 18 months was the tenure on average, right? First 6 months, you spend a bunch of money. Next 6 months, you recoup that in cash. And then you basically have 6 months of net like cash contribution. So our goal when we started was to just lift us from 18 months to 24 months, because that would double the amount of profitability.
Sure.
We ended up going to 36,
wow,
which was great. But that all came from, we weren't focused on everyone on the team. We were focused on our therapist. When you thought about benefits and whatnot, there's like sacrifices you make when you're thinking about one group over another.
Yep.
So that's kind of more what I'm thinking about than like finding the most productive salesperson.
Sure.
Or the most productive therapist. A lot of organizations do that. I think key leaders too, like they're rarely forgotten.
Yep. Yeah.
Or less. They have a bigger voice.
Stand out.
Yeah.
Yeah.
As a country, we usually do like individual feedback more often. So you're thinking about someone like Brandon Shue individually, a lot of times more often than the department. So yeah, high level. Let's talk about you.
Okay, great.
So let's talk about baby Charlie. Where'd you start your career?
Yeah. Okay. So I came out of school. I was a finance accounting major and at Boston College, and it was a great time to be interviewing for finance and accounting jobs. Fall of 2009. So, needless to say, I had a pretty tough go. It was probably the first time in my life I felt like I failed. Everything was pretty easy for me up until that point, and it was a humbling experience. I'm glad I got to, get knocked on my butt.
How many interviews did you have?
I probably had, 15 interviews, 20 interviews, and as many more resumes that ended up in a dumpster or more. And so
it's almost worse not to hear back.
Yeah, at least tell me why you didn't like me. But even when you didn't move on to second round interview, you didn't get a lot of feedback either. You just didn't get a call back, so you're getting ghosted by the finance community. But no, I mean, it ultimately, I got lucky. I ended up 2 weeks before graduation and thinking I'm going to go live in mom and dad's basement for the next however long it takes me to get a job. I get a call for an analyst gig at a private credit company in Boston. So I had to quickly pivot, find an apartment, and start my career. So worked at a company called New Star Financial. So it was all lower middle market private credit for private equity backed buyouts. So got a broad array of different deals that I looked at. Different industries to underwrite and dig into. So it was just great, amazing training. And frankly, the biggest thing that I took away was how to ask good questions. I thought that was the hardest learning curve, was just figuring out, okay, you get this deck in and all the supporting diligence information and figuring out what questions do I want to ask to better understand, is this deal going to work out well? Is it not? How bad can bad get? So I thought that was the most important learning experience, was just figuring out how to ask good questions.
So in 2009, I picture all sorts of bad debt.
Yeah. So it was great. Like in terms of how do you underwrite how bad gets? Well, we just saw it, so you could really see, here's how a company might have performed pre-recession, through the recession, and now emerging from the recession. You kind of had like an easy button as an analyst. And so now it'd be pretty tough. I mean, minus COVID, but you'd see a bunch of up and to the right financials for a lot of businesses. And,
yep.
And you don't really have an understanding of how sensitive performance is to this happening or that, and how quickly can they cost cut to maintain margin, et cetera. So I honestly had it pretty easy coming out of 08, 09 in terms of debt underwriting. So.
Is that just because they were starting to recover?
Yeah, businesses were emerging. So, call it summer 2010. I left spring of 2012. So you started to see, companies emerge and start to perform better, at least compared to how they did in 08, 09. So, I mean, it was an interesting time. But I happened to get connected or put on 2 deals. They were both 2 of the largest private equity roll-ups of insurance brokers at the time. And I did a couple other insurance industry related transactions too. And, I think my boss came to me and it's like, Charlie, you're going to be our insurance analyst. I'm like, that. What are the odds of that? Because I grew up in and around the insurance business. My grandpa started the an insurance brokerage back in 1952. My dad joined him in the 80s, bought him out, and then added 3 partners in the 90s. They did an ESOP transaction. They sold 100% of their equity in 2005.
Okay.
So, they were already well into their ESOP journey at that point in time. And I remember walking back from the office and going, oh, you wouldn't believe the deals I'm working on. It's in your business. It's a hell of a business you got. And I think that was his light bulb moment to see if I wanted to join. And to which, I thought I had a different path for my career. And but he started telling me a little bit more about it. My dad did. And it was a really great story that they had building. And I thought, well, I could maybe be sort of the M&A guy inside an ESOP platform. If you're a small agency owner and you're looking at your transaction alternatives, how cool would it be to sell to a group where the day you close, you got your cash, but you and all your employees get to participate in equity from that point on too. So I thought that sounds cool.
And there's tax advantage to that as well, right?
Yeah, depending on the transaction, like if you're a C-corp ESOP seller, you can 1042 exchange your proceeds into like-kind securities tax deferred. So there are advantages there. And then again, I think for the C-corp though, there's some drawbacks, like the seller can't then participate in the equity build in the ESOP. So depending if you're a 37-year-old seller, you'd opt to not defer the tax so that you can participate and get 25 plus years.
But if you're a 73-year-old seller.
Yeah, then take your chips and defer your tax. So it was great. I joined the company then in 2012 and, didn't really have a job description. It was sort of, and this is how the company was back then, 70 employees. And it was, okay, what do you want your title to be? I'm like, I don't know. So I was sort of go help people out. It's kind of the nature.
Go learn the business.
Yeah, go learn the business and figure out, here's some projects. And honestly, it was really like project work. And, I was out meeting people in the industry and trying to drum up opportunities to buy. Other people had other networks, and I'd be the transaction guy once you get into a deal. So it was just a baptism by fire, drinking from the fire hose, but I didn't really have a clear, here's what you're in charge of.
What title did you pick?
Business development, which felt vague enough that no one really knew what it was. And so, I'm developing business, but it was I probably looked more like an FP&A person, if I'm being honest. And
well, I'm sure that developed over those.
Yeah, and that was my comfort zone.
Right?
I was an analyst, so that was kind of where my skill set was, and what I knew I was good at. So, I tried to better understand the business from the finance side inside, and then extrapolate it out. So, it was a lot of staying close to the accounting team at first, understanding sort of the ins and outs of the business financially, to understand, okay, where are there opportunities to add value, what processes don't seem effective or efficient. And it was just helping people out.
So what was the first thing you bought?
First deal we bought was actually SMA Insurance in St. Cloud, Minnesota. So it originally died and then came back around, but it was a decent little deal for us at the time. I mean, probably doing a little over $2 million in revenue. We were 12 at the time. And
so that's a lift.
That was a lift.
Significant.
Yeah. And so it was an interesting process, start to finish. You're talking directly with, there were 4 owners, one who was the majority owner and looking to retire, 3 that were minority owners, and trying to figure out, okay, and they had no plans near term to retire. So it's okay, where are they going to go and have, the next 10 plus years of their career in an environment that they'd enjoy, right?
So now it's pretty obvious that the ESOP model is super attractive to that kind of diverse need. Was it clear when you were coming in? Are you good on your pitch at that point, or was it kind of coming together?
I had the math pitch down, right? Because you could show, okay, here's you could take a check and walk out the door, but don't give up your day job, and you're really finding a partner that you're going to enjoy working for and with for however long you want to go. And plus, you got the secondary equity build as a plan participant too.
We're going to get into that in a second, because I think that is, this is probably just my quant side, but I think that's super sexy.
Yeah, it is. And it's the second bite of the apple, so to speak. And
it's a great reason to stay.
Yeah, it is. But it's also a great culture aligner, right? And so it's not, because you could still have some sellers. And granted, let's rewind the tape. This is 2012, 13, 14. When I joined, there were maybe 5 or 6 PE-backed platforms in the insurance brokerage marketplace, and now there are 50. So
plus some pretty significant publicly traded roll-up.
Correct. Yeah. So the amount of capital and competition for deals has pushed pricing up to a point where we're no longer, that spread, that delta is pretty hard to overcome as a competitive acquirer. But for the right dynamic, the right people, the right seller mindset, it still works great.
But now it's got to be more of a, we're coming in because we want to be a partner and part of this.
Correct.
Less, we would like a big check.
Yeah, our check.
And some of us would like to stay.
Correct. Yeah, exactly. I think the disconnect there is a little wider. And, if you're at the tail end of the career, you don't have any other partners, maybe that the bigger number just sounds more enticing. You punch your ticket and away you go. But, I think we found great partners.
Okay, so let's go. I like that first one.
Yeah, so
there's 4 partners.
4 partners.
They're doing about $2 million a year. So I'm guessing they have like ops staff of.
It was like 17-ish total people, maybe 18.
So that was probably a bigger impact on your total headcount than.
Yeah, it was. And
how many of those people did you hold out to?
Almost all of them. And some of them, like one of them became our long-term controller and who's just now retiring this year. So, you always get really the thing I learned about it is, you end up, because of the secrecy of a deal, you're generally just dealing with the principals of the firm. And you don't really realize what you get in terms of talent until after the close. And, more often than not, I've been so pleasantly surprised with the level of talent that we've picked up after the fact. But it was a great lesson learned, too, in terms of what's important in a deal, because really an acquisition in our space is just, it's hiring a lot of folks, onboarding a lot of business, and doing a big system integration, and then writing a big check. You can boil it down into that simple of a form. What you don't know is, it's not an orderly hiring of people. You're just inherently hiring them without going through an interview process. So what we've done more recently is, in the deal we did 4 years ago, we actually engaged with every single employee before the close. We sort of had the framework of the deal worked out with the sellers, but before we closed, we said, we want to make sure everyone is on board and comfortable with who we are, comfortable with the role that they have in the organization today and going forward. And it's a very unorthodox approach, I think.
I bet the individuals that select in love it.
I think it treats them like people, because
versus like inventory.
Well, yeah. Think about psychologically. You're working for some other group one day, and then you wake up the next day, and someone tells you, "Surprise! Here's your new employer." Yeah, that doesn't feel good.
No, but that's normal.
Yeah, it's normal, and
super
people
normal.
Don't have agency then over their own destiny. And I think that even though, and here's the best example of it. So that going back to that first deal, fall 2013, and so I'm hot shot Charlie,
business development Charlie
at like 26 years old, and I go to St. Cloud, or it's the day after closing, and everyone gathers in a conference room. I'm like, congratulations, you all own the business now, and I'm thinking everyone's going to be psyched. What could go wrong here? And someone raises their hand and says, I don't think this is a good idea. And I was totally unprepared for that type of reaction. But
I feel like you could swing, like you're pretty good.
Yeah,
on your feet.
I asked, well, why is that? And she went on to explain a situation with a failed ESOP. And all of a sudden, this ESOP over here in a completely different industry that didn't work out so well.
Yeah.
It all of a sudden makes
ESOPs
all
are
ESOPs
in no way a silver bullet.
Yeah, and I just said, look, an ESOP doesn't make a bad business all of a sudden miraculously good, but if mismanaged, it can take a highly well-performing business and impair it from a cash flow perspective. But it's not going to fix a busted business. So
yeah, and it's not going to fix like a good business.
No.
Like it's just a structure.
It's a capital structure.
Yeah.
I mean, I think it gets it's a complicated structure to manage sustainably, but if you can figure it out, it works great.
Yeah, as long as you have consistent cash flow.
Correct. Yep. Realistic valuation, consistent cash flow, and a strategy around how you're transacting your shares. It's not, but it's if the whole saying is, if you've seen 1,000 ESOPs, you've seen 1,000 different ESOPs. So it's very true. I mean, everyone's got a slightly different structure and management style to that side of the plan administration.
And I'm going to jump back to the fact that, and this from our other conversations, you have a slightly different structure so that you have some tax advantage. Do you want to talk about that quick?
Yeah, I mean, so we're 100% ESOP-owned S-corp. So because, and that's been in place since I think 97, the S-corp rules around ESOP. So K1 goes to the ESOP, which is a qualified retirement plan.
Yep.
therefore has no tax liability. Therefore, the company retains all the earnings and there's no tax distribution made.
Which is huge when you have a relatively young employee population.
Yeah, no, it's great. And you go through demographic cycles in ESOPs, right? And there's ebbs and flows to it depending on how shares are allocated, when your demographics are maturing. But what you gain in tax savings, you also gain in lumpy repurchase obligation with share buybacks. And so you got to get really good at forecasting in an ESOP. But the government eventually gets their tax. It's the ultimate tax deferral, but they get their tax.
Tax deferral combined with an investment is great.
Oh, it's great.
It's great. Having qualified money, which is like a 401k.
It's a supercharged
fantastic.
401k. Yeah.
Especially because you have way more autonomy in your investments, right?
Correct. I mean, we're doing ours off balance sheet, and so off corporate balance sheet, and so you get a little more. And we do a lot of private investments, and our thesis around that is people have enough exposure to the public markets with their 401k. So we don't need to double down on public markets. We have a little bit of that exposure, and I think it's healthy to have some liquid assets in equities, but we don't need to go too crazy on that front.
So alternatives, you like real estate,
private equity, mezz debt, some oddball stuff, a little bit of venture. I not so much an investor as I feel like I'm a capital allocator and just building a portfolio and trying to simplify it. I think we've learned a lot along the way.
Do you traditionally ride coattails of people for investments? Yeah, I mean, like somebody that's actually doing the diligence, et cetera.
Yeah, you try to, or it's not even too much direct investing in this company or this company. We've done a little bit of that, but always in those cases, always looking for an institutional player in the same security that we're in, and so.
But you like things like Groove or...
I like funds, I don't, you could say, getting 2 and 20 is expensive, but it's not that expensive compared to the work they're doing and the talent that it takes to do that.
I want that 20 to be as big as possible.
Yeah, exactly. So I think that's especially for where we're at, we're an infant in that journey. And so it just doesn't make sense to do it any other way and just find good managers.
And you actually let your team help pick these alternatives, right?
I'm sort of the one-man band. Our board acts as our investment committee. So we've got a board of directors that's the primary governance body of the company. Good governance in an ESOP is important. You have trustee.
Some would say critical.
Oh, it's critical. I mean, in some cases you could argue it, a lot of ESOPs probably have better governance than a lot of publicly traded companies.
Well, I mean, it does make sense.
Yeah. And so you have trustee.
Everyone doing the governing is effectively governing their money or a portion of their money, right?
Exactly. I mean, we try, so you have trustee, you have board of directors, and you got management. And ESOPs are it's a little circular for the board because the board hires the trustee and the trustee appoints the board. So, if things go sideways, it's
like a circular reference.
It gets a little
in
messy,
Excel.
but you try. So I'm in internal trustees, so that's most groups hire external, but I've opted to be internal trustee and then rely on a mostly outside board. So we've got a mostly outside independent board. So they, in my mind, they truly act as that governance layer for the business.
But then I know Brandon Chu, right? He sometimes gets engaged on what you're investing in, right? Like how do you make people, because I know there's a feeling of inclusion, right? Yeah. Which is awesome. I would say that's a form of comp.
We've got a bunch of salespeople. They're highly entrepreneurial, running around. And, so they're always looking at opportunities, and I get plenty of deal flow just from them where they have got prospect or a client. They're like, hey, you should look at this,
you
or
let
that.
Them look through decks and stuff.
Yeah. So, I mean, they're looking at stuff alongside, and I think so they get a kick out of, how we approach it. But, I really, we're trying to simplify it a little bit more. We used to do more, hey, we like this deal, let's go club together some money and pass the hat, see who's all, and try to include people. in that. But, over time that gets to be pretty messy too. And, not to get in the weeds, but
that's a whole thing.
yeah,
Because then now that's a different, another relationship.
Exactly. So, I mean, we're trying to simplify it as much as possible. And at the end of the day, like all these folks will have exposure to these assets through their participation in the ESOP.
Yeah.
So, I mean,
I'm guessing they can always do follow-on investments
exactly.
if they want to.
They can go direct if they want. And we're just trying to not play middleman on that.
Yeah. Being a fund of funds to your employees
it's a little,
that could get dicey.
it could. Yeah.
Yeah.
So
it's all fun when we're making money.
Exactly. Yeah. You don't want to be the bearer of bad news.
Yeah.
But it's been a good strategy. I mean, it serves the purpose of how do you put your balance sheet to work and not be, caught having to be playing just in your vertical. If our charge was the only thing you can do with your balance sheet is to go buy other insurance brokers, I'm not sure that'd be the best thing for the benefit of our plan participants.
So you've gone from 70 to 260 employees. So basically quadrupled. I picture, because of this the ESOP strategy, you get more tenured talent. But what does your pipeline look like? How do you hire?
I think that was the big pivot, was as M&A became less attractive financially to us, it really repivoted the focus on the business to how are we building an organic growth story, an engine. And so, that just gets down to find good talent, recruit good talent, retain great talent. So,
and when you're finding good talent, are these people out of undergrad, or are they people that have 2 or 3 years of experience?
It's a little bit of both. So I think for, the production, the insurance producer, we have a very maybe old school approach to the type of producer we're trying to hire, which is a highly technical producer. So they know, they have a niche, they're subject matter experts in it. They know it really well from a technical knowledge, from a placement knowledge, et cetera. And they're good at selling. So they're really...
So those are not new to the field.
They're not new. But so we're going after seasoned, proven winners that maybe they're the firm they were with sold and they feel like, where's my opportunity? The opportunity for meaningful equities off the table. Let's go get them.
So you're finding the talent that's lost in deals.
Correct.
Or maybe ignored in larger organizations.
Yeah. And I think our pitch is simple. I mean, if you have 25 plus years left in the tank, the amount of equity build you can have over time in an ESOP is tremendous. And so, I
mean, it's silly.
Yeah. It's just the power of compounding.
You still get your 401k.
Yep. Still get your 401k. And, you're getting the supercharged benefit. You're not having to cut a check to buy into the equity. It's just granted to you. So it makes it a great recruiting tool. Mm-hmm. But then on the flip side, it's what are we doing to bring new people into the business too? So I think you're running both strategies of how do we find proven good talent out there that understands the value of what we're bringing to the table with the ESOP and the cultural environment that comes with that. And then marrying it with what's the right way to bring new people into the business? Because it's hard, and it's not like we're in a sexy industry.
What are you talking about? Yeah. It's the new med device.
Yeah, that's right. Yeah, it's if we had ChristensenGroup.ai, maybe we'd get a few more candidates.
Please no.
But it's no one goes to school thinking I can't wait to get into insurance. So a lot of people sort of happen into it as sort of a pivot, maybe a few years into their professional career.
So going from like 150 to 200, if you retain people, I'm guessing your retention is
retention's great. It doesn't mean you retain everybody,
but that means you don't retain everybody. Yeah. No one should retain everyone. Yeah. That means you're not being selective and you don't have a culture. You're just
exactly.
Nothing good comes out of that.
So but I think
that takes a little pressure off of how many people you have to hire to continue to grow.
But it does.
150 to 200 is like, you and your board can probably find 10 people a year to hire, and that's meaningful growth.
Yep.
300 to 500, that's a different game.
Yeah.
Are you talking about that a lot?
Yeah, we brought a full-time recruiter in 3 years ago, and it was one
How
of
are they
those,
doing?
great. And it was the right investment. And I think we hired 60 some last year, and so you can't do that with just. It puts too much pressure on your HR team.
Yeah, or like a hiring manager.
But you're trying multiple fronts. You have employee referral bonuses, you have full-time recruiter, you've got outside recruiters.
I like recruitment raises.
Recruitment raises?
Referral raises.
Oh, yeah. That's nice. That's a good way of doing it. Might have to take a page out of that.
Give someone like $2,500 every, and like the question is, what if they hire 25 people and it's like, then they make a bunch of money and they grew the business. Great. That's the best problem.
Yeah.
And it's going to be really hard for that person to leave because that person will bring people with them if they leave. So it's like, I'd rather overpay the person that can go find a bunch of talent.
Yeah, that's pretty clever.
It's sticky.
Yeah, it is. And, but it's there's you hit different growth walls. I don't know if you felt that.
Oh, yeah. It's like, I always picture like activity-based accounting.
Yeah.
Where you have like, oh, we've hit the plant's capacity. We need to add another line.
Yeah. Yeah, it's kind of like that. And the culture feels it, the operation. So I feel like we've hit like 4 or 5 walls in my 14-year tenure, and you just have to figure out, okay, what do we need to do differently in order to create the capacity to get to the next wall.
Yeah, you probably just hit the point where like you don't know everyone's name.
Oh yeah.
Isn't that weird?
Well, COVID also like screwed that up too. Because all of a sudden we were hiring a bunch of people that aren't in the office, and and that was like, and all of a sudden I normalized not knowing everyone's name. And
dude, it scared me for a while. Like it made me avoid the office.
Yeah.
Because I was like, I don't want to, like I care about everyone, but you might not know the last 60 hires. That's a lot of people.
So, Microforum thought it was the coolest thing. So we actually knocked it off and formed and created the same program and named it CG Meet. And, as much as we've expanded and grown here, we've also just added offices. So we've got 11 offices.
How many states?
We've got Texas, Kansas, Illinois, and here. And so, and a smattering of people.
You got to get Florida.
I know. That would be actually technically we do. We've got a couple employees in Florida, but not a true office. But
dude, Naples. That's where.
That's where.
That's the spot.
All right. That's on the to-do list.
Put it on the to-do list. Yeah, you can like. Did I tell you I'm moving to Naples?
Are you?
Yeah.
When are you going?
Like this summer.
Okay.
But there's like they do a monthly Minnesota breakfast.
Oh, fun.
And there's like 350 people that go there.
Good for you.
At this country club, which is kind of fun. Well, dude, the sun.
Yeah. I don't blame you.
The sun is so great.
I know.
I like to run outside. But yeah, it's like wild when you think about just the way I'm sure Texas came out of just a lot of businesses and people have moved to Texas, Austin specifically, right?
Yeah, I mean, it's you want to follow a tailwind, right? And part of it is, it's a great thesis, but it still has to start with a great hire. And we made one great hire, and that snowballs into a few more great hires. And you wake up 5 years later, and you're like, wow, we actually have a legit business here.
Do you ever seed a market with a couple of good team members?
It kind of did by accident. So Kansas City, we had a longtime great producer move his family down there for warmer weather to Kansas City, and it's better, sort of.
I mean, like 15 degrees is a lot.
Yeah, it makes a difference.
This time of year.
Yeah, their golf season is a lot longer than ours.
Yeah, they get an extra like 90 days.
Yeah, it's I'd take all 90 of those. So
that doubles ours.
Yeah, but we were like, that's great. He understands our DNA, our culture, and it was okay. Let's build around that. Let's go hit the recruiting trail and see who we can bring on board. And he's been a great culture ambassador and leader for that office. So, that happened by accident. And then we had when we made our Texas hire, we had another great producer move his family down just because he wanted to warmer weather. So it kind of worked out well that way just by accident. But yeah, I mean, you get asked, well, where are we trying to expand to next? And part of it is, well, hey, I'd like to continue to invest in what we currently have to get to critical mass, whatever that looks like, maybe 50 people per location. And but at the same time, part of it is just dumb luck and who you bump into and who the story is going to resonate with. And if you found someone who's a rock star, you'd say, yeah, fine, we'll build around you. Yeah. Let's go.
Especially when there's not like pressure on how many and what amount of time. It's like going from 1 to 5 is pretty low pressure.
It's doable. I mean, it's a lot more work, and we're learning the nuances of managing a multi-state, multi-location operation. But
yeah, especially like in a regulated industry, I'm sure that.
Yeah, no, it's complicated, and there's layers to it. I mean, it's complicated from a regulatory. It's complicated from sort of how we interface with insurance carriers and how they view different states, all part of the same contract or appointment or not. And then nuance of market dynamics by state. What are market norms? And so, yeah, I mean, we're learning as we go, and feel like it's getting a little bit easier every year.
I love it. So, part of what I'm working on is I have these little slides that are going to end up being a workbook, but currently they're just drawings. Okay. So when I think about comp, right, there's 4 categories. You got pay, benefits, work-life balance, and culture, right? And I think most organizations don't think about these at one time. They instead are like making comp decisions or thinking about healthcare, et cetera. So they don't...
In a vacuum.
Yeah, you never like frame it out and say, this is what we're spending across the board, especially on a segment of your business. Like, I'm guessing sales is critical for you guys. Most organizations can't do all these things well, right? And the really good ones are honest about it when they're hiring people. They say, oh, we're like, for you, your long-term incentives are killer.
Yeah.
Which is part of why I assumed you have older staff, because like in your 20s, it's a different kind of hungry.
Yeah. Oh, you have to. I mean, I think it's hard. To your point, it attracts a different priority. But I think we got some people that get it.
Oh, yeah. No, it's like, but you have a very distinct proposition compared to like an MMA or some of the other large houses,
I think
right?
What we try to harp on is we want to be market competitive for pay, benefits, and blow it out of the water on retirement plan. Mm-hmm. And so that's at least what we try to preach. But it's an interesting, like, how do you layer in your culture? And
but when I think about like, if you just look at those different categories, right?
Yeah.
If you look at like work-life balance, I'm guessing you have a ton of flexibility. That's just inherent. Yep. But like efficiency is a thing that I think is rarely considered. Are there any of those areas that you just cop to not being the best at?
I'm sure we're not the best. I mean, to your point, there's always trades. So someone might, I find the hardest one to be benefits. And we're in the business. So, I'm intimately aware, but, if you're a part of a large publicly traded company, your biggest differentiator is having a killer benefits plan because there's no, save for maybe a couple of the key leaders, no one's participating in equity.
It's such a small amount.
What I try to tell people is like, we could ratchet up our benefits contribution level. It's just going to come out of your ESOP value.
Yeah.
So you're all paying for one way or the other, right? And so it's trying to find where's that equilibrium level where it's competitive enough to not be out of line with the market, but it's not so competitive that it's cutting into the more important benefit that we have, which is our ESOP.
Which you're included on.
Which you're included in. Yeah. So I
would say, that's being transparent. A lot of organizations wouldn't touch that.
Yeah. I feel like I have the easiest open enrollment conversation every year because you go, okay, everybody, your benefits costs are going up by 10%. How do you want to pay? Your W-2 or your ESOP value? It's not me that
it's
profits.
Us.
It's us. So, but at the same time, it still doesn't, the dollars and cents today still matter to people, to most people. And so it's striking that balance of, what do we need to, how do we need to perform as an ESOP to remain competitive in the market of, how brokers perform from a capital markets perspective. We have to be competitive. The minute we start saying, well, we have the autonomy to make trades so we can run less well than our peer group, all it does is create the pressure point build of us not being able to maintain our structure as an ESOP anymore. So we have to, there's a gray area, but we can't get out of that gray area. We still have an obligation or maybe a fiduciary duty as an ESOP to have a certain level of performance relative to our peers, right?
Yeah, that makes sense. But I'm hearing a fair amount of transparency in this.
Oh, yeah. I mean, we try to be. And as much as we can, you try to communicate as much as possible. We've got our annual ESOP meeting next year. So every year we do our share price reveal. We invite all our employees, come to town, their spouses, significant others.
Have a reveal party?
Yeah, it's a reveal. But we go through, it's really like a shareholder meeting, right? And
it's not like a shareholder meeting.
It is a shareholder meeting.
Yeah.
And so we do that. We report the news. We talk about how we're doing as a business. We talk about, where we're going, where are we positioned in the market, and then really try to educate on how does share price work? How does this ESOP actually work? And what drives it to perform really well? What drives it to perform not so well? And it culminates with the share price reveal, which historically has been great.
Do people sometimes opt out because of the ESOP?
Opt out of
work, like employment?
I don't know if I've had anyone say, I don't want to work for you guys because you're an ESOP.
But do they use indirect language to get to that, where it's like, I really value the higher percent?
Yeah, I mean, I think
or whatever.
Yeah, I mean, you get the examples of someone that leaves us for a $2,000 raise. Meanwhile, that's marginal compared to the value of the ESOP, even annual contribution, let alone the growth factor that's attached to it. But
I mean, what's like the percent long-term incentives that?
So we target 15% of pay in annual stock contributions. So
plus 401k match.
We don't do a match just because, but you can contribute to your 401k. But
so there's another one where it's like 401k you're not going to win on.
But think about that 15% as that's the match equivalent.
Oh, I would take the 15% all day, but that's the thing you have to probably explain to people.
Exactly. Yeah, they have to understand. Well, yeah, you're getting it over here.
Like you've had experiences where you didn't share that with somebody. And then they show up the first day and they're like, there's no match? And you're like, no, because there's this super meaty ESOP contribution, which is...
And that was, historically, the four partners...
And you can still put $18,000 or $19,000 away, which is actually way better.
And we have great participation. I mean, I think it's testament to we've got an internal 401k team that sells to their advisory services to others. But, I think our participation rate's like 97% in our 401k, even though we don't do any match in it. So, I mean, I think people understand.
There's no way you're not hiring a more financially adept group. And if you aren't, you're training them. You're constantly you're taking all of them to shareholder meetings.
Yeah, this is like a repeat something 7 times to get it to really sink in.
Yeah.
But honestly, what I've seen is it takes people 5 to 6 years of being in the plan before all of a sudden the light bulb moment goes off because they get their statement in year 6 and all of a sudden maybe their account balance went up by more than their W-2 pay that year. And it was like, oh my God.
And then they talk to each other about this too, right?
Yep. And so because
it's kind of like an amazing cultural phenomenon that you probably experience now that you're, almost 20 years in?
20 years into an ESOP, yeah.
Yeah. So there's people that have, I'm guessing out of your 280 employees, you probably have 50 to 75 people who have watched their value grow really significantly at all levels of the company.
It's really cool to see. I mean, big picture, you go, what does success look like in this thing? And it's, how do you have a couple hundred millionaires that this business provided for over time? And not everyone's going to stick around for the whole ride, but for those that do, I mean, that's a reality.
When someone leaves the ride, how do they exit the ESOP? Does it have to be immediate?
Let's say you terminated today. You go through the end of the year, and then it gets into sort of the ESOP administration process. Your shares are then bought out next year at whatever this year's valuation is.
So you have somewhere around 18 months to plan for that.
Correct. Yep.
Okay. So that helps with the forecasting.
It does. And frankly, it's what you're really trying to forecast are the end of, the people that are going to go along, because they're going to be the largest shareholders by virtue of longevity. And so you could forecast, retirement dates, and we actually have mandatory diversification starting at age 61. So that makes it a little bit easier even then to start to plan out, when are we going to need to get the shares back?
So talk to me like I'm a middle schooler. What is mandatory
diversification? So we put this in place maybe 10 years ago, but it was once a participant hits age 61, they have to start selling their shares back to the company. And what that does is it enables us to more easily forecast. So instead of having to guess when you're going to retire, I can just sort of plug in, here's when you're turn 61, 62, 63, et cetera.
At the very least, you're taking down the impact of that person retiring at 73.
Yeah, correct.
Yeah.
And frankly, philosophically, where you've seen a lot of insurance brokerages fail to perpetuate long-term is when the owners hold on too long, right?
Yeah.
So
it's just like wealth managers, right?
Yep. So you extrapolate that out across a broad ownership population, and the same conclusion could be true. Or if you've got a lot of people that hold on too long, you're going to end up with the same conclusion, which is probably can't perpetuate, we'll need to sell, right? So it's been a great mechanism for us not only to cash manage better, but to better align sort of the equity with who's the future contributor of the organization.
Does the ESOP show up in your mission and values?
I think it validates it.
What's your mission and values?
Mission and values? Well, we talk about our 4 C's, which I think a lot of brokers talk about 4 C's. I'm going to go with we might have come up with it first and everyone's knocked it off.
Of course, that's what I heard.
Yeah.
Everyone copied the Christensen Group.
That's right. Yeah, you heard it here first, at least on this podcast.
Yeah.
And so we talk about client, carrier, coworker, and community, right? Those are primary constituents that we serve. And so, it's really how are we serving those different constituents in a way that doesn't impact negatively any of the others, right? So, and this shows up, you could be an employee who's awesome with clients, but if you're asked to your coworkers, it's not going to work long term. You can't be a 2-legged stool, 3-legged stool out of 4 legs. You really have to be a good custodian for those 4 groups.
So maybe a 3-wheeled car.
Yeah, maybe a 3. I mean, three out of the 4 ain't bad. So
I mean, it depends which one, right?
Yeah, it depends. So that's really the core of sort of our mission and who we're hoping to serve. More broadly, I want to be, in terms of big picture goal, what's the mission? How do we be the largest 100% employee-owned platform in this industry?
What's currently the largest?
And there's some privately held models out there where they don't have any outside ownership, but the largest,
it's consolidated, I'm guessing, in most cases.
Yeah, I can't think of who it is off the top of my head, but
just give me an idea of like what kind of size.
Oh, maybe $300-400 million in revenue.
Okay,
maybe 5. But in terms of pure play insurance ESOP brokers, there's a couple, and we're all kind of in the same ballpark of range. So, and there's a lot of blue sky ahead of us. So honestly, if any one of us could, I'm rooting for all of them, right? But it'd be great if we can sort of be the first, but
I want you to win.
I do too. It's fun.
So I'm like a big fan of like find your competitors and work with them. I would rather be friends with my competitors, and we don't all need to learn every lesson on our own.
Yeah. So there's we recently joined maybe 3 years ago, a great industry peer group called Assurex. And That's been incredible for us. It's a bunch of high-performing, historically regional brokers that look a lot like you, but in different markets and even around the world. And so the amount of collaboration that exists within that group is unbelievable. And everyone's just trying to help each other out in their journey. And frankly, it feels like there's just as much, maybe more collaboration between Assurex members that have no shared common ownership than there might be at some of the national broker platforms, where this office would never interact with that office.
No, they don't like that office.
Yeah, and maybe they're siloed. Yeah, by profit center, it's to their disadvantage. So, I've been so impressed by the people that you meet through that network and how much you learn from them.
When you started, were you kind of like, this might suck? Or did you have enough like inroads to know that it was going to be high value?
We circled around each other for years, and
because it's kind of scary going and sharing like, oh, this is their special sauce.
Yeah, I think you always felt like you had networks of people that you could call and go, hey, have you looked at this tool, or what, if you dealt with this situation, and we have, but we also were going through a generational turnover of leaders, and it was one of those, we were losing a lot of those relationships. Yeah. And so this felt like the easy way to buy your relationships in a way. So that was maybe the primary goal, and it went well beyond me. It's not solely for my benefit, but it's how are we upskilling everybody in the organization and finding their peers across these other Assurex members.
Has that been really helpful with like AI?
Oh, for sure. I mean, there's so much noise out in the market. There
are too many tools.
Yeah, 3 new tools every week, and trying to figure out, okay, where do you focus your time, and it's how do you call people and go, have you tried this one? No, okay. Oh, you did? Okay, what'd you like about it? What didn't you like about it? It helps avoid a lot of lost resource along the way.
Yeah, I would much rather
time and money. So it's been great. I can't say enough good things about that organization and the value we've gotten out of it. So
I love that. So when you think about, I'm just going to make you imagine this. If you got rid of the ESOP,
yeah,
what would that do to your organization?
Well, I think it depends on what it's replaced with.
But just imagine traditional structured ownership.
Like with internally?
Yeah.
Yeah.
But yeah, just what would you pitch?
I think
it feels like it's so important that would be a big hole, like a big gap.
We talk about like not letting the ESOP define culture, because then we take culture for granted, and we need to have a great culture independent of the ESOP. The ESOP should support a great culture and reinforce it, but not be the defining characteristic of it. So
yeah, to a certain extent, it helps enable it.
It does, and because I think we had and I wasn't there before, but I think people would say we had a great culture before we were an ESOP. So it didn't require an ESOP to be great. So you have to do all the other little things that you need to do to foster a good cultural environment. And the ESOP just makes it a little bit easier to get there maybe, and makes it a little bit easier to keep it. But so if we didn't have one, I'd like to think we can still preserve our independence as an organization, be a competitive platform to attract people. But that'd be
like a big hit, right?
It would. I mean, you'd lose a big recruiting advantage, particularly
and retention, right?
Oh, for sure. I mean, think about. I think there are always ownership or equity opportunities for producers, but not for the staff.
Yeah.
Not for the rest of the staff. And so I think that's been a huge differentiator for us compared to anybody else. But
yeah, I mean, I look at this was in the Wall Street Journal, so it's not protected, but like the rating that's happened for some of the big brokerage houses recently.
Yep.
And I feel like that would be much harder to accomplish for you, both because they're not pitching that, and also there's a huge tax issue if you have to suddenly actualize all your investment.
Yeah. Oh, I mean, that's a whole other complicated.
And your team probably doesn't like when somebody, like a bunch of equity leaves, because they'd rather have it work. Is that a fair assumption?
Yeah. I think it's always challenging. And again, we're not immune to losing good people because it's happened. I feel really lucky that we haven't lost a validated producer to a competitor in my tenure. And so, knock on wood. So that's been a positive, but it's hard to imagine going and working for the same organization for 20 plus years and feeling like that's your whole career. I think that's a hard thing to wrap your head around, regardless of how successful you are in the organization. So, I think you're not immune to, people are on their own life journey.
And turnover is good. There's too much turnover. It becomes a lot of work.
The crazy thing is the bigger we've gotten, what's good turnover in your mind? Like what percent? What's like a fair number?
Super industry.
Like 10%, would that be a good?
Are we counting people that are 6 months in?
Yeah, all in.
All in? Oh man, I would say if you're like, how fast are we growing?
15% a year.
I would say 10 to 12 would probably feel pretty good.
Yeah. Okay. So even at 260 employees, that's 26 people a year.
Yeah.
Okay. For the people that have been with us since I started when we were 70 employees, when you lose 26 people a year, it's all relative to that. For them, they still remember the organization at 70. So they're thinking turnover is almost a third or more than a third in a lot of ways, like mentally or psychologically. So
or 4 times higher than it used to be or whatever.
So they like think, oh my God, our turnover is so high. And meanwhile, statistically, it's very low.
It's interesting when you get to that size, though, because you have to start tracking, like, is there consolidation in some department? Is that expected? So, like, we would always have higher turnover with our admin. That's okay. That's not a full, like, no one wants to be an admin forever, right? Especially in healthcare. They're almost always working towards some other degree. But, yeah, you want to keep an eye on it because if it's, like, a bunch of producers, you don't want to lose 26 producers.
Yeah, it's where you're okay with it happening, but there's still the cultural perception of it too that you can't ignore.
How much weight do you put on exit interviews?
A lot. I want feedback. Yeah, I wish people gave more of it, especially
and
for
earlier.
Us. Yeah, because it's their business. It's your business. It's not my business. It's your business or our business, and so I love the feedback. I'd qualify with, I love feedback with ideas or solutions attached to them. But overall, like we don't pretend like we have it all figured out either. Like,
and even if you have it all figured out, it's going to change.
Yeah.
I always tell people not to be teapots. Like if the first time I hear from you is when you're boiling.
Yeah.
Like trust me, allow me to mess up with that feedback before waiting until it's like
why
an
do you
emergency.
think people hesitate to share earlier?
I mean, I think therapists are really good at secrets. So in behavioral health, like there's just not a lot of feedback and it's a very young industry, right? So like most people here's how you become a therapist, right?
Yeah.
Do well in high school, do well in undergrad, do well in a master's, maybe a doctoral program, and then you get your first job when you're like 25 to 30 years old. So like frequently we would explain like why PTO accrues to like a 28-year-old because they'd never had a full-time job.
Yeah.
Which is totally fair, but like you learn that and they're like, okay, as part of onboarding, we have to explain how benefits work, et cetera, because this adult hasn't had a job because they've been going through
school,
this educational journey.
Yeah.
When you consider most people leave, like it was when we started 55, 60% of the industry would leave before 5 years, like very, very young population. So it took a lot to get people to actually share feedback.
So is that an industry problem, or when you're talking about feedback, is it feedback about the industry or is it feedback about your business?
See, that's I think there's both, but I think advocating for as much feedback as possible, as frequently as possible and I like the idea of being solution oriented is good. And then if you have the time to have a candid conversation, it's even better. Because some things, like we were in a like double regulated industry, right? Because behavioral health is regulated and so is healthcare. And then there's like an oligopoly on top of it with insurance panels. So it's like, we don't have a ton of control. And a lot of times just explaining where we have control and autonomy was really helpful, but you need that feedback entry. So they say like, why can't I make more? It's like, oh, because we don't have control over rate. And then you break down the numbers and it's like, okay, at least I understand what's driving revenue versus just thinking there's someone taking all the money.
That's a challenge.
Because people would look at it and they'd be like, oh, $140 an hour. And then they'd multiply that by 40 and 52. And it's like, well, it's more like 24 clients a week.
Yeah. You're not billing every single hour.
Yeah. And it's more like 45 weeks a year.
Yeah. So
that's if everything goes right.
Yeah.
Like you don't get sick and clients show up. So yeah, it's like, I think there's a big part of just, you have to foster open communication.
Yeah. It's been, and that's part of it too, is the bigger you get and the more disconnected you are from, everybody on even a personal level, it feels like there's that widening perceived gap of the communication loop. And so it's been the challenge of how do you make it still feel like a small, intimate company, even as you're growing.
For us, it was like making sure we elevate the leaders so that they can also be the ones to receive feedback. Because like if it just has to come to Charlie or John or Andrea or whatever, like there's not enough time.
Yeah, that's the bottleneck.
And also, I don't know what's happening in a lot of these departments at that level. Like I'm guessing your underwriting team is doing all sorts of stuff today that you're totally unaware of.
Yeah, and there's a lot of trust in letting go that goes with that. But it's a great point. I mean, we've sort of felt like our, the greatest barrier to continued growth is making sure that we've got a team of people that are aligned to the leadership team in terms of what's important, what's not important, and how you lead your teams. Yeah. I think that is a challenge.
I love how so I would call it seeding a market, how you're growing these new markets where it's like you have a couple of good people and you go around them and you're slowly growing.
Yeah.
And it's like 50 might be like the right size at the end of the day, but you didn't say I want to be at 50 at the end of this year.
Yep.
Because I don't know what would happen, but I'm guessing it would go totally off the rails.
Yeah, no, it's exciting. It's really fun. Like I think the coolest part is of watching sort of this emerging market strategy play out is they've developed their own culture that fits inside the broader organization culture, but it's more intimate because it's a smaller team. They see each other every single day. There's something like a deeper level of connection there between those people, and they're also operating in startup mode. It's sort of let's go win. How do we go win? We got to tell a different story. We're the new shiny object in town. How do we explain that in the context of the broader organizational story? So it's really cool to see how they've sort of taken on their own unique identities. And what roles should we play in their success from afar?
How do you leave them enough autonomy to enjoy their work?
Yeah, that's the balance.
But give them enough support that they appreciate being part of the ecosystem.
Yeah, and I think we're finding where those balance, like what are our non-negotiables and where are the areas where you have complete autonomy. I think that's been a learning curve, but I feel like we're in a pretty good spot or getting there. So, and maybe it's going to constantly evolve, in terms of how much they need to rely on the parent resources, so to speak, of the broader organization versus having a completely self-contained operation wherever they are. But hopefully, I don't want it to feel so siloed geographically. Hopefully as we grow, there's a lot of reasons why we are collaborating with each other. To better support clients, leverage
it makes
different
sense
expertise
for your organization to be more collaborative across offices than maybe some of the other large brokerage houses, just because of the fact that like when the organization wins,
everyone wins.
It takes that 15% and amps it up.
Correct.
Which compounds. Like the math on that's fun.
Yeah, it is fun math.
But yeah. Okay, Charlie, this has been great.
Yeah. Thank you.
3 more questions.
Yes.
These are easy. Favorite leadership book?
Oh, I don't know if it's a leadership book, but one that I've enjoyed that is Tribe, Sebastian Junger. And it's less about leadership, more about the value of community and tribalism. Sort of going back, it's a quasi history lesson in that and its relationship to post traumatic stress and so it's one of those. I think there are lessons in leadership that can be drawn from that in terms of the importance of creating tribalism inside of an organization. The bigger you get, the less interdependent people become on each other because they just think the organization's going to take care of them. So how do you create tribal pockets inside where people are dependent on each other and they feel more purpose and more maybe ownership of what they're doing? So
that's interesting. I'm going to check that out. Yeah. Okay. Favorite podcast?
To be honest, I'm not that big of a podcast listener because I've got about a 10-minute commute. So I've liked, so maybe I'll go with when we're on our way to our family cabin, my wife always throws on my favorite murder. So she drives the bus on her podcast.
I love
it. Experience. So
a little Discovery ID-esque.
And I'm a sucker for the murder stories and crazy.
Andrea loves those, and she always is like, you got to check this one out.
Yeah, it's pretty. There's always like crazy stories that
people get up to all sorts of nonsense.
Yeah. So I'd go with that. Cool. Or I like good history podcast. I'm trying to think. Is it hardcore history maybe?
Oh yeah, that's good. The World War I, World War II, hardcore history is like a fave.
Yeah. So I'm a big like Wikipedia rabbit hole at 2 a.m. history nerd.
Isn't it funny where you're like, I'm going just a little deeper?
Yeah. It just leads you down the rabbit hole.
The rabbit holes I've been on with AI, it's like,
sure.
Yeah. I'm like, get a little more history before you judge me, buddy. Okay. Last favorite parenting advice, either given to you or you would give.
Parenting advice. Well, yeah. I feel like I'm early in
what makes a great kid like you?
Great parents. Favorite parenting advice. And I'm 2.5 years into my parenting journey with a second kid on the way in July. So I'm not the seasoned veteran like you are, but
there's only 2 times when you're an expert with kids, and it's before you have kids and as a grandparent.
Yeah.
No one's an expert. We're all just doing our best.
We're winging it.
Yeah.
So maybe I'll give the advice that I've given a new parent is the best investment you can make is one of those exercise bouncy balls for $20. That thing worked wonders to get that kid back to bed. So not parenting advice for complex things, but that was a really good baby life hack for $20. Ask me again when I've got a teenage kid, and I feel like I might have a better idea at that point.
I feel like when you have a teenage kid, it's either like you're a pro or you're so flooded.
Yeah, maybe both. Yeah,
maybe both. Yeah, I've got 2 girls, as you know.
Yeah,
we're going into middle school next year, which
That's exciting.
I'm like excited and terrified about it.
Because how old are they then?
11 and 9.
Okay,
so.
Oof, good luck.
I mean, I love these kids. They're so great. And I feel like as they get older, they get better. But then you hear
horror stories.
Yeah. And part of me is like, I don't know if I believe it.
I think maybe just stay optimistic.
Yeah. I think every year has gotten better.
I agree. Every year has gotten better. I think everyone tells you, oh my God, life goes by in a flash and all that. And when you're in the moment, especially with maybe an infant, it feels like the days are super long.
Long days, short years, right?
And every time I caught myself thinking, man, this is hard, I'd trick myself into thinking, yeah, but imagine doing this and there's another toddler running around or something, and I was like, this is easy, and so it's like, it's just a mental gymnastics, to recenter and
Yeah, you're going to move from zone to man.
yeah. But it's good to like, I don't know, I felt like tricking myself to mentally be in the moment because you get done with work and you're beat mentally.
Yeah.
And you got to find the next gear for the
pull it
second phase
together.
of the day. Yeah.
Habit stacking is like a big thing for me. One of my favorite tricks. This is less advice. It's just a trick when you have little kids. Instead of reading them a book when they're truly babies, read them your emails.
Really?
Yeah, you get a wider assortment of like vocabulary, which is good for their little brains. And also, you get through your emails.
That's pretty good. Like we're talking, at what point can you not get away with that? Like
when they can say words back to you, I
Yeah.
think that's about then you move on to like whatever, go or.
All right.
And you can also
That's actually
read
a great
books.
idea.
It's just like in the middle of the night when you're sitting there and you're like, why is this baby crying? It's like, well, crank through 20 emails.
And read out loud. That's
Just
a great
read it
idea.
out loud. And
That might be soothing.
it's totally soothing.
Yeah.
The
That's a
number of
great
nights where I
idea.
would like pace and read emails. And then it's like, oh, well, I didn't sleep for 2 hours, but I got an hour of work done.
Yeah. It's very productive. That's
It's very
great.
productive.
I love
You
that.
might have to explain that to your team if you do it, where it's like, I'm not choosing this. It's
Yeah.
been chosen for me.
Sure. I love that.
But yeah,
That's great.
dude, Charlie, thank you for coming
Thanks, John. Appreciate it.